Hi all, good afternoon. Okay, today we are already in week 9 now, so we move to the chapter 9. So our topics for this week is the foreign exchange market. Okay, first one is what's actually the foreign exchange market. We can see it from this note. Okay, foreign exchange market is the market for converting the currency of one country into that of another country. So it's actually one of the mechanism for exchanging over the currency for another, means from ringgit Malaysia to USD. Okay, that is a foreign exchange market, and this foreign exchange market is a global decentralized over the counter market for trading of currencies. So this market determines foreign exchange rates for every currency. So it includes all the aspect, buying, selling, exchanging currency at current or determining the price. So as you can see, the way they are buying and selling the currency is different. If you go to I think Priya know better, like merchant trade, right? So merchant trade will sell different rate. If you go to bank, it sell different rate. So this is a foreign exchange market. So what is actually foreign exchange rate? Okay, foreign exchange rate is the exchange rate, is that the rate at which one currency is converted into another currency. So as you can see, if you Google now, 1 USD equal to 4 ringgit 25 cent. Okay, this is the current exchange rate. And 1 euro, same with the USD, 4 ringgit 25 cent. Okay, I hope you understand what is a foreign exchange market. Okay, now we move to the purpose or function, purpose of the foreign exchange market. Okay, the purpose of the foreign exchange market first is to enable the conversion of the currency of one country into the currency of another country. It's provide, okay, that's number one, enable the conversion of the currency of one country into currency of another. Second, you provide some insurance against foreign exchange risk, means the adverse consequences of unpredictable changes in the exchange rate. Okay, if you go, for example, if you go travel, for example, okay, this exchange rate, they will change. Okay, they're not fixed, they always change. Okay, another function, another purpose of a foreign exchange market is first, another purpose that not inside this slide. Okay, to transfer funds through one currency of another to transfer funds through one currency of country to another currency. Okay, second, to provide short-term credit to the finance trade between countries through various credit instruments, and to facilitate avoidance of foreign exchange risk. Okay, to transfer funds through one currency of country to another currency. Okay, to provide short-term credit to finance trade between countries through various credit instruments, and lastly, to facilitate avoidance of foreign exchange risk. Okay, now we move to the currency conversion. What is actually currency conversion? Currency conversion is a process of converting one form of currency into another country's usable currency based on the current exchange rate. Means that you convert, you go to if you want to go to Indonesia, you bring Malaysian money and convert Malaysian money to rupiah. Okay, based on the exchange rate. Okay, so normally the international firm, they use foreign exchange market to, okay, first to convert export receipt, income received for foreign investment, or income received for licensing agreements. Okay, they're going to convert the export receipt, income received, foreign investment, or income received for licensing agreement. Okay, to pay a foreign company for products or services. Okay, you have company in Malaysia and your company based on in Korea, so you will use Malaysian money to pay. Okay, to invest, pay cash for short terms in the money market. For currency speculation, the short-term movement of funds from the one currency to another in the hopes of profiting from shift in the exchange rates is a kind of an investment. Okay, you keep the money in as a fund, and you hope that maybe this money that have profit later. Okay, to ensure or hedge against the possible adverse foreign exchange rate movement, the firm engage in the forward exchange. So they have a forward exchange, and also they have the forward exchange rate. So forward exchange, they occurred when two parties agree to exchange currency and execute the deals at some specific date in the future. This is a forward exchange. And forward exchange rate is the rate governing such further future transaction. So these rates are currency exchange are typically quotes for the 30, 90 or 118 days into a future. So the foreign exchange market can be used to provide the insurance to protect against the foreign exchange risk. So this is the possibility that unpredicted changes in the future exchange rate will have adverse consequences for the firm. A firm that protect itself against the foreign exchange the organization that protect themselves against the foreign exchange risk, we call as a hedging. Okay, if you want to protect yourself against the foreign exchange rate risk, you call it as a hedging. So there are three ways of market that performs the foreign exchange risk, that perform this hedging. Okay, we have a spot exchange rates, forward exchange rates, and currency swaps. We go one by one. Okay, the first one is a spot exchange rate. Okay, the spot exchange rate is actually the current price level of the market to directly exchange one currency for another for delivery on the earliest possible value date. So in other words, it's actually the rate at the which foreign exchange dealer converts one currency into another currency on a particular day. Means it's on spot, a particular day. So normally this is determined by the interaction between supply and demand, and so change continually. So spot exchange rate is when you convert the money on the particular day. Okay, there's a spot exchange rate on the spot. Then we have forward exchange rate. Okay, the forward exchange rate, you also refer as a forward rate or forward price, is the exchange rate at which a bank agrees to exchange one currency for another at the future date when it enter into a forward contract with an investor, because it's forward. So the exchange rate governing a forward exchange means that future date. Okay, the date is not yet, it's in future, that's why I call it forward. So a forward exchange, they occurred when two parties agreed to exchange currency and execute the deals at some specific date in the future. They have a specific date. Normally this forward rate typically they quote between 30, 90s or 180 days into the future, means 30 hari, 90 hari, 180 hari ke hadapan. Okay, this is a forward exchange rate. Okay, the last one is a currency swap. Okay, what is currency swap? Currency swap is actually the transaction in which two parties they exchange an equivalent amount of money with each other but in different currency. So the purpose could be to hedge exposure to the exchange rate risk, to speculate the direction of the currency, and to reduce the cost of borrowing in the foreign currency. Okay, it's actually they exchange an equivalent amount of money with each other but in different currency. Means to simultaneously purchase and sell of a given amount of foreign exchange for two different value dates. So swaps are used when it is desirable to move out of one currency into another for a limited period without incurring foreign exchange rate risk. So actually, sebab as I told you, right, this exchange rate ni dia akan berubah. So this currency swap ni dia macam you have the equivalent amount, you exchange ada certain amount of money tapi in different currency. Sebab this foreign exchange risk, kalau you tak buat all this currency swap, all that things, or all this forward exchange rate, the rate it can be, kadang-kadang mungkin satu hari nanti the what we call the name, rupiah tu lagi mahal daripada duit ringgit Malaysia. So you must do this thing to protect yourself from the foreign exchange rate that always change. Okay, what is the nature of the foreign exchange? This is foreign exchange, foreign exchange market. First, the foreign exchange market is a global network of banks, brokers, and foreign exchange dealers connected by electronic communication system. Okay, the market is always open somewhere in the world. So if exchange rate quotes in the different markets were not essentially the same, there would be an opportunity for arbitrage. Arbitrage means the process of buying a currency low and selling at high price. Okay, most transactions involve US dollar on one side, and the US dollar is a vehicle currency. Means everywhere you want to use US dollar. Okay, what factors are important? What factors are important to future exchange rate? Okay, what are the factors that important for determine the future exchange rate? Okay, 3 factors that have important impact on future exchange rate movement are: first, the country's price inflation. Okay, this price inflation means that it's like balloon, right? You fill with ni terapung, okay? You fill with the gas, make it blow up, Okay, this is of inflation. So the second factor is a country's interest rate, and third one is a market psychology. Okay, next question we have: how are price related to the exchange rate movement? Okay, the answer: in order for you to understand how price and exchange rate are linked, we need to understand the law of one price and also the theory of purchasing power parity. Okay, we go to the next slide. What is the law of one price and what is the purchasing power parity theory market? First is the law of one price. In competitive market free of transportation costs and barriers to trade, identical products sold in the different countries sell for the same price when their price is expressed in terms of the same currency. Okay, this law of one price mean that it's actually one of the economic concept that states that the price is an identical asset. Okay, the price are the same at the community, that they will have a same price globally. Means all this price all around the world are same, regardless whatever the location it is, when certain factor are considered. Okay, this is the law of one price. Wherever you go, it's only one price. Okay, they're not going to have many price. Okay, next we move to the purchasing power parity theory. So given relatively with the efficient market, which mean that market in which few impediments to the international trades and investment exist, and the price of the basket of goods should be roughly equivalent in each country. So what is actually purchasing power parity means? Okay, purchasing power parity is the measurement of prices in different country that uses the price of the specific goods to compare the absolute purchasing power of the current country's currency. Okay, that is a PPP, purchasing power parity. This is a measurement of prices in different country that use the price of the specific goods to compare the absolute purchasing power of the country's currency. Okay, this is an example. I don't know whether you understand or not, because I try to understand also. Okay, example: if a basket consists of one computer, 1 ton of rice, and 1 ton of steel, was $1,800 in New York, and the same goods cost 10,800 in Hong Kong dollars. So the PPP exchange rate will be 6 Hong Kong dollars for every $1. Means that maybe the price of burger in Malaysia is maybe 20 ringgit, and the price of burger in US is maybe 5 ringgit. Okay, so you can see this PPP exchange rate. Okay, purchasing power parity exchange rate. That's why some people they said, in US, eating fast food is actually, if you don't have money if you eating fast food, but not in Malaysia. Our fast food is very expensive compared to fast food in US. Okay, you understand what I mean? This is purchasing power parity theory. Okay, this PPP. Okay, PPP, they predicts that change in relative price will result in the exchange rates. When inflation is relatively high, a currency should depreciate. Okay, so if we predict inflation rate, we can predict how a currency value might change, and the growth of the current country money supply determine its likely future inflation rate. Okay, so next we go to the next question. Okay, this is like quite answer question. How well does PPP? What is PPP mean? Sekejap, we check again. PPP is purchasing power parity. Okay, empirical testing of the PPP theory indicates that it is not completely accurate in estimating exchange rate change in the short run, but it relatively accurate in the long run. So this PPP normally work in the short run. In the long run, not in the short run. It's more accurate in the long run. Okay, how do interest rates affect exchange rate? Okay, there's a Fisher effect. States that the country nominal interest rate is the sum of the real rate interest and the expected rate of influence over the period for which funds will be to be lent. So this is the formula lah for interest rate. Okay, nominal interest rate I equal to R plus L. So if the real interest rate, it is the same everywhere, any difference in an interest rate between countries reflects differing expectation about inflation rates. Okay. Okay, before I continue to the next slide, okay, this is a code for this week quiz. Okay, very short one. 09 IBFX 09 IBFX. I repeat, 09 IBFX, all capital letter, no space. Okay, next we go to the an efficient market. Okay, is one of which price reflect the all available information. If the foreign exchange market is efficient, forward exchange rate should be unbiased predictors of the future spot rates. So most empirical tests confirm the efficient market hypothesis, suggesting that companies should not waste their money on forecasting services, but some recent studies have challenged the theory. Okay, this market efficient, they refer to how well current price reflects or available relevant information about the actual value of the underlying asset. So a truly efficient market eliminates the possibility of beating the market because any information available to any trader is already incorporated into the market price. So this is an efficient market school. Okay, next we move to the inefficient market school. Okay, an inefficient market school is actually one of which prices do not reflect all available information. In an inefficient market, forward exchange rates are not the best predictor of future spot exchange rate, and it may be worthwhile for international businesses to invest in forecasting services. However, the track record for forecasting services is questionable. Okay, this inefficient market is one of one that does not succeed in incorporating all available information into the true reflection of what assets fair price. So this market inefficiencies exist due to the information asymmetries, transaction costs, market psychology, human emotion, among other reasons, and more, and so on. Okay, next we answer the question, how could exchange rate forecast be prepared? Okay, they have two approaches to exchange rate forecasting. We have a fundamental analysis and also technical analysis. Okay, this fundamental analysis normally you draws upon economic factors like interest rate, monetary policy, inflation rates, or balance of payments information to predict exchange rate. Okay, it normally this fundamental analysis it depends on the economic factor. Okay, such as the example of the economic factor such as interest rate, monetary policy, inflation rates, or balance of payment information in order to predict the exchange rates. Then we have a technical analysis. Okay, they focus on the trend and believe that past trends and wave are reasonable predictors of the future trends and wave. Okay, technically they have a trends, they have a graph, so they will based on the trends and also wave. Okay, there's a technical analysis. Okay, next we move to the currency convertibility. So there's a question: are all currencies freely convertible? Means are all currency able to change? Can you convert all the currency? So the answer is currency is freely convertible, externally convertible, and also non-convertible. So a currency is freely convertible when both resident and non-resident can purchase unlimited amounts of foreign currency with the domestic currency. So this is a free convertible, means that you can just both resident or not, sorry, both country on the people that live in country or not, you can purchase unlimited amount of foreign currency with the domestic currency. So this is a free convertible. So we have externally convertible. So this externally convertible when only non-resident, okay, only non-resident can convert their holding of domestic currency into the foreign currency. Okay, only non-resident can convert their holdings of domestic currency into foreign currency. Then we have a currency non-convertible. Okay, when both residents and non-resident are prohibited from converting their holding of domestic currency into the foreign currency. Because I don't know, I never I can say I never travel, so I don't know whether there's a non-convertible currency. Like I know, for example, like I've been to Myanmar just now, like beginning of the year in Myanmar. You can convert Malaysian money to their money, but unfortunately in Myanmar all the proses membeli ni semua are in USD. They not really use their own currency. Everything in USD, which is I feel like the cost of living there is higher compared to other place. But you still can change their money, but the amount of their money is really high. Sometimes billion, million. Lepas tu dia punya duit yang paling banyak yang dia ada pun mungkin dalam 50,000. So when you want to pay something, you need to hold duit yang sangat banyak, and the amount of that money is very little. That's why they are like to use USD compared to their own currency. Okay, why do countries limit currency convertibility? Kenapa country there limits this currency convertibility? Okay, the main reason to limit convertibility is to preserve the foreign exchange reserves and prevent the capital flight. Okay, capital flight is when resident and non-resident rush to convert their holding or domestic currency into the foreign currency that they want to rush. Okay, that's why they are limited. They are limit. In the case of the non-convertible currency, firm may turn into counter trade. Okay, counter trade means the barter-like agreements by which goods and services can be traded for other goods and services to facilitate international trade. Okay, this counter trade is actually the international trade by exchanging goods rather than currency purchase. Okay, you like barter system lah, system barter. You used you want to exchange good, not the currency. Okay. Okay, next question. What does the foreign exchange market means for additional international firms? Okay, firms must understand the influence of exchange rate on the profitability of trade and investment deals. So this exchange rate risk can be divided into three: transaction exposure, translation exposure, and economic exposure. Okay, transaction exposure. The extent to which the income from individuals' transaction is affected by fluctuation in foreign exchange value, and this can lead to the real monetary loss. Okay, this transaction exposure is a level of uncertainty businesses involved in the international trade face. So specifically, it is the risk that currency exchange rate will fluctuate after the firm has already undertaken the financial obligation. Then we have a translation exposure. Is the impact of currency exchange rate changes on the reported financial statement of a company. So they deals with the present measurement of past event, and gains or losses from the translation exposure are reflected only on paper. Okay, it's actually the risk. Okay, translation exposure, also known as a transaction risk, is the risk that the company's equities, assets, liability, or income will change in value of result of exchange rate changes. So this occur when the firm denominated a portion of the equities, asset, liability, or income in the foreign currency. So one of the risks. And then we have economic exposure. So economic exposure is the extent to which a firm's future international earning power is affected by changes in exchange rate. So it's concerned with the long-term effect of changes in exchange rate on future prices, sales, and costs. This economic exposure, they also known as the operating exposure. They refer to an effect caused on a company cash flows due to unexpected currency rate fluctuation. Okay, next, how can firms minimize transaction exposure? They can buy forward, use swaps, leads, and lag means payable and receivable, paying supplier and collecting payment for the customer early or late depending on expected exchange rate movement. Okay, we go to the next one. So how organization can reduce the economic exposure? Okay, there's two. Okay, we skip this one. Okay, how a firm can reduce economic exposure. First, to reduce economic exposure, firm needs to distribute productive asset to various locations so the firm's long-term financial well-being is not severely affected by changes in exchange rate. This required that the firm's assets are not overly concentrated in countries where likely rise in currency value will lead to damaging increasing in the foreign price of the goods and services they produce. Okay, next, are there other strategy to manage foreign exchange rate? Okay, is there any other ways to manage foreign exchange rate? Okay, to further manage foreign exchange risk, firms should first establish central control to protect resources efficiently and ensure that each subunit adopts the correct mix of tactics and strategy. Distinguish between transaction and translation exposure on the other hand, and economic exposure on the other hand. Attempt to forecast future exchange rates. Establish good reporting systems so the central finance function can regularly monitor the firm's exposure position. Lastly, produce monthly foreign exchange exposure reports. Okay, they are the step. Have 5 steps here, so no need to take everything. You just take the important point only. Okay, that's all for today's class. Oh, it's not up to 30 minutes. Okay, let's try it until 30 minutes. Okay, this is a foreign exchange market. We still have another 10, 11, 12, 3 chapter to go. After that, I will give you the assignment question. So you only have maybe 1 week or 2 weeks to do your assignment. Okay, so okay, if you don't understand anything, you can message me, no problem. I think that's all for this week. Oh, not yet. 30 minutes. I just wait for 30 minutes. That's all for this week. We're going to learn another topics lah after this. I have 3 topics more. Hopefully we have time to cover everything. That's all for me. See you next week. Bye bye.